Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's April 10th. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. You know, I'm not sure how American Airlines is still in business. I mean, I'm 0 for 10, at least over the last 2 years, flying with them. I know some of you are like 10 times. You flew with them 10 times over the past 24 months. Well, you guys know I'm on the road a lot, at least twice a month, sometimes 3 times, visiting companies, investors, going to conferences, speaking at conferences. But this week, this was Monday, a couple days ago, I had to fly to Baltimore to tape a shoot for our next promotion, which, by the way, I think is going to be amazing and really good. And the company I'm talking about, it's not just a name that you can make money on, which I really believe you will. But I really got attached to this story since I interviewed some of the top people in law enforcement, activists, veteran police officers, been around 30, 40 years. And the company that makes a new product, it's probably going to be on the belt of every single police officer. I'm not just talking about the country, but has a chance, I mean, even getting interest globally right now. It's really incredible story that no one's talking about. If you're a subscriber to Curzio Venture Opportunities, you know what company I'm talking about. And it's a product that saves lives. So I'm really excited about it. Remember, we're 100% independent, and the company did not pay me a dime to promote them. My job is basically to show new subscribers a great pick, right? People that don't know my brand yet. And if I make them money, they become subscribers for years, hopefully decades. And if I don't, then you know what? Then they're going to cancel the subscription. And that's the way this business should be. This industry should be, right? Unfortunately, it's not really like that right now. Whether the stock goes up or down, it really doesn't matter from the publisher's point of view. I mean, a lot of financial newsletter publishers are going to make money. The editor is going to make a fortune, right? They're not even, most editors outside of our company aren't allowed to buy their own picks. They could tell you it's going to go up 60 times, 100 times. They can't purchase it. They're not allowed to. And then what happens? Everyone's making money except the subscribers. A lot of these subscribers to these products, the mom and pop investors like yourselves, they're getting crushed on a lot of these picks. And sometimes it doesn't matter to some publishers out there. Not all of them, just a few. It's getting a little crazy. But Curzio Research, I kind of like our method better, right? It's put up or shut up. I mean, that's the way I always did business. At least that's how I was taught by my father, my mentors. And that's the reason why I've been doing this for over 2 decades. And you'll see me cover my losers and my winners and everything, because you learn the most from your losers, of course. Anyway, getting back to American Airlines. So when I book my trips, I usually do it through Expedia, because a lot of times I'm booking my trips late unless I know I'm attending a specific conference like 4 months from now. Consumer Electronics Show is one that I go to every year. Sometimes the Value Investing Congress, whatever. And Expedia, just gives me the best options when I have to book something right away. So I was supposed to fly home late. This is on Tuesday night, last night. Get home around midnight. Have the podcast today, Wednesday. It's fine. And they wound up canceling my flight. So I have to tell you, cancellations and delays, the last 10 times I used them, almost every single time. I don't know. Maybe it's me. Some people say, oh, I hate this airline, that. For me, it's just American Airlines. Maybe it's just me. Maybe those are the only 10 flights they canceled the whole year. I have no idea. But every time I use them, thank God I only use them to fly home. Using Expedia, you can use different airlines. You don't have to use the same airline. It's just, whatever's the best and timely for me. But they canceled the flight, and I was supposed to, come home late. So I had to get a hotel a mile away from the airport in Baltimore. And then I just flew Southwest direct here to Jacksonville. But I got in a few hours ago, still in time to do this podcast. I didn't miss a podcast. But it's just every time I fly with those guys, it's just, I mean, I don't get it. I really don't. I mean, there's no surprise the stock is off close to 30% over the past 12 months. That's no surprise to me. But when you use that, right? I mean, when you have your experiences, and I'm not talking about one experience, 2 experience, but it happens a lot, you see it reflected because it's probably not just you. So that's why I always tell investors, the individual investor has so much more power than they think they have because you're out there. You're looking at different things. I mean, sometimes hedge fund managers don't do that. They'll look at the numbers, whatever. Not all hedge fund managers or not all investment advisors, but you're out there looking at things in real time, seeing like, hey, are people starting to go to Chipotle? Well, yeah, the lines get a bit longer and you're seeing the stock go higher. Whether it's they're going into a different shop or a different store, or, people are buying stuff. I mean, the price of milk is going up, whatever it is. I mean, you have that ability to really see what's going on. I mean, we should get off of flights all the time. I talk to cab drivers, which I'm going to talk to you later, my educational segment. Ask him how business is, how's it going, what's a Lyft driver, an Uber driver. But they'll give you real-time information. And when, American, it's no surprise. I started doing the homework fundamentals when I got, like at the airport. And last night when I had to get back to my hotel saying, man, it's crazy, right? The airlines are doing great, but American Airlines is not really doing too good. It's down close to 30%, again, over the past 12 months. And they just lowered their guidance again, blaming the government shutdown. Are you kidding me? And they also blame Boeing, right? Grounding their MAX 737, something I'll get to later on as well. And all that's BS. I mean, those are BS excuses. Since less than 2% of their entire fleet is the MAX 737s. You can't tell me you're missing earnings because of that. There's no way. You just don't get. You go to your website and book, and they still have these drop-down menus. It's even hard to book a flight on these things, even when you use the app. I just don't get it. But then I look at Delta, close to its all-time high. And yes, I'm going to pat myself on the back a little bit for that one, since I do talk about my losers a lot. But I was recommending that name in the 30s in, let's say, about the past 2 years. About 2 years ago, 2016, a little bit longer. This is before Buffett decided to go all in on the airlines. I mean, this is a company that's also paying you north of 3% yield. Now it's 2.5%. The stock's been going higher. But if you look at Delta today, it's trading at 8 times forward earnings, meaning it's cheaper today than when I recommended it back in mid-2016 in the 30s. And how could that be? The price is high. It's because their earnings have skyrocketed. I mean, most airlines have finally figured out how to make money. They charge for everything, upgrade your seat. A lot of these things are worth it to some people just to get that extra leg room. Look at a company generating $7 billion in operating cash flow, generating over $11 billion in income with a market cap of just $39 billion. And when I look at their dividend payout ratio, it's just, dividends related to how much it's generating in earnings, it's 23%. We talked about AT&T being up there around 60%, but if you get closer to 100, that's when you want to worry. Most utilities around 60, 65%, maybe a little bit higher. 23%. And I have to tell you, analysts, any analysts listening out there, maybe junior analysts, if you want a project, I mean, I could probably find this out, but it's been a little crazy. But if you, interested in doing a side project for me, I'd like to know how many companies in S&P 500 are paying more than a 2.5% yield, and their dividend payout ratio is less than 25%. I don't think you're going to find a lot of companies. A lot of companies with 2.5% yield, their dividend ratio is north of 50%. And what does that mean? It means Delta has significant room to raise their dividend. I mean, they just told you about the operating cash, the cash flow they bring in, plenty of cash to buy back loads of their stock, which they should do right now since it's trading at 8 times forward earnings. And by the way, those earnings are projected to grow much faster than the overall market. So we're not buying like a value trap here. We're buying a company that's growing tremendously, faster than the overall market at a discount to the overall, what is it, 16 times earnings, 16.5 times earnings we're trading at right now? Forward earnings? Like 8 times forward earnings. Are you kidding me? I mean, this is how many times you buy a growth stock that's under 10 times earnings? Usually it's a value stock. You're trying to buy it. Maybe they have growth catalysts coming up. Catalysts are going to, able to get into some of these names like cheaper. I mean, Microsoft, I think, was trading under 10 times earnings at once. Now it's much higher than that as, they went to cloud and they have a new growth model. IBM's multiple is going to get higher too as they get more into services, which they're doing. I think it's a number one performer in the Dow right now, IBM. When you look at companies like this and you're paying attention, for me, someone who flies, I mean, Delta's a no-brainer even here as a long-term holding. And AT&T hasn't been that good. And I talked about GE, which, that's on me. But there has been a couple winners. Lots of winners in the large caps, and this is one of them. Continues. But, man, American Airlines, I don't know. I don't know if it's me, but every single time. And I had to book them because it was the only way I can get home last night. And I wound up that I didn't get home last night. I got home this morning, a few hours ago before I'm taping this podcast. But, hey, I never, ever miss a podcast because I love you guys and I love doing this. Anyway, have a great show for you today. My interview is with a pretty okay guy. He's all right. You may know him. His name is Michael Alkin, who writes the Moneyflow Trader newsletter for me, Curzio Research. It's a newsletter that uses conservative option strategies to basically bet against individual stocks. So he's not shorting names where you have that unlimited risk, right? You get crushed if the stock continues to move higher, higher, higher. He's using options that will increase your returns significantly compared to shorting if the stock moves lower over the next 12 months. That's important. Because I've seen people be dead right on their thesis, but wrong on their timing. When they predict, wow, this stock is terrible, it's going to crash. And that stock runs away from them and they get crushed. They have to cover their short position. And you'll see that stock maybe a year later, 18 months later, go down significantly. So when you're using options, again, time is a big factor, is the factor. But when you have 12 months and you have your thesis saying, hey, these guys are not going to make the numbers. Maybe they make them this quarter, they might not make them next quarter. If you have a 12-month time frame, and think about it, guys, if you really believe the market's overvalued, which, hey, we're getting there. I'm not finding as many ideas as I used to. I was finding them a lot more over the past 3-4 months, especially when the market really got hit in December. It's not that easy right now. If you're believing the market's overvalued or someone who believes the market's going to crash, this is a newsletter you want. Mike's a 20-year hedge fund veteran, host of his own podcast called Talking Stocks Over a Beer. It's getting tons of traction where he interviews hedge fund guys. Hedge fund guys are very difficult to get on podcasts. Since he's been in the industry, he's got a good name. He's got a lot of great names on that podcast. Again, Talking Stocks Over a Beer, absolutely for free if you guys want to listen to that. So he's super smart, forensic accountant, and he's going to share a few ideas with you. I'm talking about popular stocks that are probably sitting in most of your portfolios right now that he believes are going a lot lower. It's going to be a great interview coming up. In my educational segment, I'm going to break down some of the biggest stories in the market right now. It's going to be Lyft, right? I talked about last week, which I told you to avoid. It's down a lot, right? Pushing $60 now. I'm going to break it down even further. So I started to do even more digging and found even more interesting stuff that's probably going to scare the crap out of anyone who's long the stock right now. Also, I'm going to revisit Boeing, another name I told you to avoid, and it's been falling. But it's a time to finally buy this name. So all this stuff factored in. It's going to be good, this segment, because I actually talked to several pilots who listen to the podcast, who have flown these planes. You may want to give a listen before you take any position in this stock. It's going to be a fantastic educational segment, guys. Definitely don't miss it. Before I get to that, let's get to my interview, the one and only Michael Alkin. Michael Alkin, thanks so much for coming back on the podcast.
Hey, buddy. How are you? My pleasure, Frank.
Well, I have to tell you, I have to give you a shout out, man. Your podcast's getting a lot of traction now. I mean, you're actually like a podcast guy. Did you ever see that like 2 years ago that you'd actually be doing a podcast today?
Never. Never. My wife laughs because I'm an introvert. So she laughs. She's like, "How do you talk for an hour and a half?" Like, and A and B, who cares what you have to say? So that's what my kids say. So there you go. Yeah, no, I never did. Never did. It just kind of happened.
And it's funny because I say the same thing. Like I even say, I'm like, man, I can't believe you guys like listen to this that long. But I just we try to make it entertaining and it's cool too. I mean, it's almost like therapy, right? Because you could rant and everything, you get everything off your chest, but you really get a chance to tell your story, not in writing, but when you see things that are BS out there or that people are focusing on. It's just it's I don't know, it's just a different medium that works.
It's funny, right? Because I listen to some podcasts where I learn a lot, and they go right into it. Boom, hi, let's bring our guest on, and I have no idea who these people are. I don't get to know them. Because they interview someone. I don't know who the interviewee is, but I like to know the interviewer too. So yeah, I spent the first 15 or 20 minutes just talking, rambling about what happened over the weekend. And some people like it, some people don't. And as I tell them, if you don't like it, a lot of other podcasts go listen to it.
So, it's nice when you have a free podcast, right? You can say, hey, if you don't like it, hey, listen, there's other free podcasts.
Free. There's no advertisers. We don't get paid. So hopefully you like it. You can fast forward through my babbling and my hockey talk and my stories. If you don't like it, that's cool too. So yeah, but it's fun.
No, that's awesome. That's awesome. So listen, there's two big topics I want to talk about here because we want to get through this really quick. And the reason why we're getting through quick is because it's my fault because I just landed and not too long ago. And we published a podcast today and I never miss a podcast. But You did some incredible research on the shale companies. This is an industry I'm familiar with. Vision Shale Company, all the major shale areas in the U.S. I think I visited in like 2011, 2012. We were able to make a lot of money on these companies. But when you took a fresh look at this industry over the past couple of months, I mean, you provided incredible research, and I love what you did for subscribers, where you have like a glossary of the terms, and you really broke it down of things you have to understand, because people just throw out numbers and EBITDA and this and that, and just, sometimes it's hard to understand. But some of the findings were pretty interesting. I mean, some of the things that people aren't really saying out there, and I want you to talk a little bit about that, because people out there that do own some of the big shale companies and even some of the smaller ones, but there's a lot of interesting things going on, isn't there?
It is, Frank. It's and my gosh, you and I have talked about this before. Going back to 2014 when I was bopping around the Bakken shale place, when you were paying $500 a room for a Hampton Inn hotel, and the roughnecks coming in off the rigs were buying $300 bottles of wine. So you've seen booms and you've seen busts. And, the last several years, obviously, I always say the shales are the unintended consequence of fiscal monetary policy of the global financial experiment, right? So as you go into these shale plays and you're you call it tight oil, if you will, and you're extracting, because of technological advances that can extract the shale from the oil and the gas from the shale, and then you could go across horizontally, so you just don't have to go straight down. You can also go across quite a bit, so you have the opportunity to find more stuff. And I'm talking in layperson terms, but that costs money, and it costs money, and it costs a lot to find it. And what you saw, though, because of interest rates that were near zero starting in 2007, 2008, 2009, after the global financial crisis, and the global central banks just lowered rates next to nothing, money was looking for a home that could pay a decent yield, and it was able to you were able to finance these through high yield debt. A lot of these oil and gas shale plays, right, from all over the different shale plays, the Marcellus, the Utica, the Bakken, the Permian, all of the different ones throughout the country. I won't name all of them, but one of the things you started to notice was that no matter what price oil went to, they weren't generating cash flow, and so it was because it was costing a lot of money. But that gets kind of glossed over when there's a environment where people are dying to put capital to work, and they're reaching for yield, so you can go out and finance hundreds of billions of dollars worth of debt on future production growth. And one of the stories that you see is, as I said, as the more and more money thrown at it, the more and more production you saw, even when prices went higher, that you saw free cash flow just evaporating. It wasn't there. I think 6 to 7 to 10 companies don't generate free cash flow in these shale plays. So, what piqued my interest about it is my interest in nuclear power. Not any part of my thesis whatsoever at all, but it's interesting to know other sources of generation, and natural gas has really taken a big role, a leadership role here in U.S. natural gas generation, and it's hurt some of the nuclear power plants in competitive markets where they have to compete on an auction basis, and that has hurt them, because the price of natural gas has gone down to sub $3. When it was common, you would see it $8, $10, $12. So that made me curious, really. Let's dig a little deeper here and understand what's going on. And because what's assumed forever is natural gas is always going to be sub $3. And it matters because if natural gas went from 3 to 5, that changes dramatically the economics of a U.S.-based nuclear power plant. So as I started doing it, I started looking and saying, my God, no matter where the price of oil is, most of these guys don't make money. And they got a couple $100 billion worth of debt, and that debt's coming due. And you started to notice in the late fall of last year that the high yield issuance for these shale plays, the appetite was really starting to wane. And as that appetite was waning, you say, well, wait a second, if you don't have people willing to finance these so easily, when this debt comes due, these guys are going to have to pay a lot more in interest rate, right? It's supply demand, just like in anything. Just like the stuff they're pulling out of the ground, it's based on supply and demand. Same thing with capital. If a lot of people are willing to finance it, you could issue debt at a lower rate. If not a lot of people are, you got to issue debt at a higher rate. Now that matters when you're not generating the returns that you think you were going to generate on that debt that you borrowed. So you have to re-up the debt at a higher rate. But what you've seen, though, is you have seen some investors come in to the space where they are talking about, hey, I wouldn't necessarily call them active activists, but they're starting to hold companies' feet to the fire and saying, listen, this isn't the world of profitless prosperity here. You can't just keep saying we got a great technology. And one of the themes has been U.S. energy independence, right, where we've produced so much oil, tight oil, shale oil, and natural gas that we are, for the first time, supposedly energy independent. And that gets people excited. Well, yeah, sure. But again, capital markets finance these companies, and at some point you got to pay the piper. And so I'm not so sure how energy independent we are. Well, these activist investors or these soft activists have come in and said, listen, we're kind of demanding production cuts. And because what's the point in keep producing if you're going to not make money on it? That doesn't matter. And so you've started to see talk of production cuts, and in the shale plays, what you see is when somebody says, normally, Frank, what do people like when they're looking at oil and gas? They like big land plays and they like big production growth. Well, now what you're starting to see is companies get rewarded for cutting back production, right? Because, well, that means they might lose less, or maybe there's a point where they can make some money or generate some more free cash flow. So the capital markets have a strange way of working these things out. And when investors are in there and demanding a certain thing, companies will eventually have to respond because they're going to need their capital. And so I don't know how energy independent the U.S. remains if you see these production cuts. And I won't get we don't have time. Won't get into it now. But you can the way these companies account for reserves too are very aggressive. And so you can make a strong argument as to their the way they were estimating what the future, what reserves are and what future production would be that might not come to fruition. So yeah, I think if you are a shale owning a shale play, it's I don't know, I'm not going to list which ones which ones they are, but you need to at least start to think about, take a look at your company's income statement, their cash flow statement, and say, okay, great, they're showing all this production growth, but are they generating cash flow? When is their debt coming due? Right? What are they paying now for their debt? What's the environment like for the debt that they're going to have to roll it over? Those are important things that you have to ask. So if you do own it, it's been, you might have had a nice run. And it's, Frank, with all these cyclical industries, people get lulled into the narrative. And it's the recency bias. Yeah, sure, look at what they're doing now, but let's think about the future. And I think that there's enough of an argument to be made that you need to be cautious and at least know what you own.
Yeah, and you bring up good points there because these guys really pushed out their debt, when oil prices fell from whatever it was 3-4 years ago. It's from, it was 90 to 100 steady for years. And then all of a sudden it just went down, oversold. I think it went below $30 for a little bit, 2029. But now, it bounced up. It's up tremendously this year. But they're even saying that oil prices need to be well above 90 for a long period for these guys to actually be able to pay off a lot of their debt.
Right.
It's pretty crazy. It's amazing how much debt that they have. But yeah, and it's also interesting. The numbers are going down. You've seen the production numbers coming down. But, even though oil prices are going higher, it seems more that if these things are participating, it might be a good time to short some of these names because as oil prices go higher, you're going to see more increase in production probably from, even though they cut recently where OPEC and Russia and things like that. But it is interesting. It's just.
Well, Frank, and that's, when you look at the debt, you're talking, you could see a couple $100 billion in debt coming due in the next few years. It's a lot of money. And when you've been bleeding cash flow, you go back to 2010, minus 15 billion. Minus 20 billion. I'm talking industry-wide. Minus 30 billion. Minus 15 billion. Minus 30 billion. Minus 25. Those numbers are staggering. Those are I mean, that's negative free cash flow numbers from the industry. That's massive. I mean, negative. I mean, depending on what companies you include in a list of companies I include, it's almost $170 billion in negative free cash flow. I mean, that's a staggering amount of money, and a staggering amount of debt has been accumulated. But again, it's funny, right? It's why'd this happen? Because capital needed to go find returns. And these are high yielding, meaning a lot of them, not all, but a lot of junk bonds. They offer higher yields, and capital, when it's in search of money, it will go find the higher yielding stuff. And when you dress them up and you make it look good and you tell a good story around it, and there's a real narrative, and meanwhile, what's been ignored during all this? The offshore stuff, right? 30% of the world's oil comes from offshore oil and gas exploration, but with all of the focus here on the shale plays, what you see is the offshore, has been left pretty much for dead. And whether it's companies that build these rigs, whether it's companies that service them, they send people out there, the service companies, the drillers, literally left for dead. So, it's funny, right, how things happen in these cyclical businesses. When they're left for dead, the valuations start to become kind of silly, good silly. And it doesn't take much to swing the pendulum back, if nothing more than the mean reversion. But all of a sudden, what you've seen also is massive amounts, hundreds of billions of dollars in offshore projects that are going to be needed to bring on that million barrels a day of oil of growth that the world's going to need. You need these offshore projects, and those projects have been put on the shelf. And so all of a sudden, what tends to happen when all of a sudden you wake up one day and say, look at that, it's hard to finance these companies, or they're struggling a little bit. All of a sudden the market will gravitate back towards the offshore type of plays. And then you're sitting there looking at securities that are incredibly cheap. But again, these things take time. It doesn't take, and a lot of what I notice with a lot of investors is they want immediate gratification. These things can take, a few years to play out. But the way I always look at these things is, what am I buying? If I'm buying offshore stuff, it doesn't have to work today, but can I buy a security that might have 2, 3, 4x upside? Okay, yeah, possibly. What's my downside? Could I be down 20, 30%? Yeah, well, I can't find that in the regular market, if you will. That doesn't exist. They're not going up 2, 3, 4x. If I could find that, and that asymmetry in risk reward, I'm willing to wait a few years. I'm willing for it to go down. I'll put a little position on. I'll buy more on the dip down, because I'm just looking for those things that are just asymmetrical. And asymmetry doesn't exist in a lot of places. I think it exists in the offshore space.
Yeah, so great stuff there, Mike. I mean, just watch those onshore oil producers where you're seeing that massive amount of debt that was restructured years ago coming back. And there's a lot of credit agencies that are warning about this. And again, oil prices are going up, so you might not see it too much now, but it's definitely in trouble. I love the offshore angle as well, which is fantastic. Now, I want to move on because there's a stock we're going to talk about, which you've been talking about for a while. And a lot of the points that you made to me, even on this podcast, even through your newsletter on this company, people are finally starting to make those same points today that you saw coming a while ago. And I'm talking about Tesla, where you first, I think when I first started talking to you about this stock, maybe over a year ago, you're like, I don't know if it's a fraud or not, but this stock is going to go a lot lower. They just, tax credits going to disappear. You didn't believe Elon Musk. We all knew he was crazy. And then it seems like to me that you're like, it actually could be that. I mean, I don't want to throw out that word and put words in your mouth, but it seems like you're getting much more bearish on the name along with a lot of other people. Where do you stand with Tesla at this price right now?
I mean, I don't get involved in the Twitter debates on it. It's not fair to people in that subscribe to our work. But B, the people are crazy, right? I'm out there with my real name, and you've got these lunatics out there hiding behind, whatever fake name they have on Twitter. If you say anything bad about the guy, but actually at this point, I don't give a shit. So, I think Musk is a genius at one thing, and that's knowing how to raise capital. Has been heretofore, and separating people from their money and getting them to invest in whatever he's working on and dreaming a dream. That's his genius. I think the rest is just noise. Anytime, for me, Frank, anytime I see people lauding someone as the next whatever, as he's a god and he turned things into a cult, to me, that raises my suspicion. I mean, what's this guy done that's been profitable over 15 years? I mean, he ultimately sells businesses, but he on paper he's worth what, $20 billion? Let's see where Tesla settles out. But at the end of the day, this has always come down to really a few things for me. Number one, I've made a living for 25 years over history. Often, if it doesn't repeat, it often rhymes. And, things just happen, cycles come and go. And one of the things, one of the immutable laws of building automobiles is it's a really tough business, right? And there's only so much profits to go around. And to do that, you got to kick, scream, claw for market share. And when you do that, it's a tough business. And my view has been that Model X and Model S are really fine cars, and they've been out for a long time now. And if you got in a Model X or a Model S, these are the higher end vehicles, and you really had nothing to benchmark it against. So you got in the car, and the acceleration is like nothing. It's like being in a rocket ship, right? You're like, holy shit, this is cool. And you paid over $100,000 or $90,000 for the car, and that's great. And that's where I think they should have stayed as a niche car maker, because what you're really doing now is, I think at the end of the day that Holman Jenkins wrote a fantastic opinion piece in the Journal today, and he basically talking about people comparing this to Apple, and if you look at the iPhones around the world, that's great, but the reality is, and he goes on to point out, which somewhere along the way I think I've talked about, is an EV isn't an iPhone. Everyone has a car. The car already fulfills the basic function of a car. And there's only limited profits from selling cars. And so it's not like you think about the iPhone. Think of how many people didn't have one. They had to go out and buy one. So it was a smartphone. It was new. In this particular case, tax credits really matter. McKinsey did a piece about a month or so ago. It was a very good piece, and you could talk about the importance of subsidies. And, you get in the U.S., you got the $7,500 tax credit. That ended December 31st, got cut in half, and then July 1st, I think it is, it gets cut in half again. And then every 6 months it gets cut in half when you sold over 200,000 vehicles. So here's Tesla, had a first mover advantage, got to the 200,000 vehicle mark, and now the tax credit goes. And if you'll recall that Musk was out a couple of years ago with the $35,000 Model 3 mainstream vehicle, and that was going to drive everyone to this vehicle, and they took 500,000 reservations for it. Well, they're just now saying they could come out with that vehicle now, but they're still not. So that's where you need to be. But now take away that tax credit that's got cut in half, another half, and now you're just kind of going to be a car maker selling into. And when they did this push for the year end, for the first quarter, I should say. The third and fourth quarter, they had this huge push because they focused everyone on deliveries and how much production they were going to make. And they exhausted that reservation list. Towards the end of the year, if you wanted a Model 3, you could have got it, but not the 35,000 version, the ones in the high 40s. If you wanted a Model 3, you could have got one in a few days. Now, how is that possible when you have a waiting list at one point believed that wasn't 500,000, then it got moved down to 400,000? And if you supposedly make, which I don't think they do, 5,000 a week, and you had a waiting list of 400,000 people, that's what, 80 weeks? How were you able to get one in a few days? Well, I know because I have sent videos to a friend of mine who puts them up on Twitter, as others who go around the country and see vehicles in the thousands. Mine's well over 100 where I live, but there's thousands of vehicles in inventory of this Model 3 that's supposedly in tremendous demand. Well, not at that price point, and they're going to struggle with the $35,000 price, and the credits are getting cut, and there's a spate of new cars coming out. So what's happened is the Model S and the Model X are the real high-margin vehicle. That's where they get most of their margins. The $35,000 Model 3 is barely, if even the higher price Model 3s were still less than the Model S and Model X. So what did the first quarter look like? The numbers were an unmitigated disaster. They delivered 63,000 vehicles, which was down 31% sequentially. And people say, well, it was up over 100% year over year. Stop. If you are financially enumerate, if you are financially analytically and understand investing, it's meaningless. The year-over-year growth on a rapid supposed growth company like Tesla, when you're in the beginning of a production ramp of the thing that's taking you to a promised land, it's sequentially quarter-over-quarter growth, because last year's base was nothing. So people sit there and say, oh, it was over 100%. Who cares? What you do quarter to quarter, because you're ramping, and take out seasonality. When you go look at the seasonality numbers, that's noise. People say it was seasonally tough. It's nonsense. So sales were down overall 31%, 16% below the consensus of 76,000 vehicles. That's a big number. It started the year at 88,000 vehicles. It started January at 88,000, and they delivered 63. Right, so if you think about it, I mean, that's tremendous. On the Model 3, they delivered 51,000. That's down 20% sequentially. That was below the consensus. I mean, it was an unmitigated disaster. But the bigger number that I think gets lost in the message is the company delivered 12,000 Model S and X's in the quarter. That was down 56% sequentially, and almost 40% below the consensus of 19,800 vehicles. And that's despite cutting prices on this thing from 10 to 40% during the quarter. Right? So most of the attention is being given to the sales of the Model 3 and the production. What Musk is genius at is focusing people on the message he wants. We could produce this number of cars. 2 years ago, they were going to produce 10,000 a week Model 3s. Now it's down to 5,000 Model 3s. But it's focusing people on production because he's got people, these test lemmings, I call them, thinking demand is insatiable and unlimited. It's nonsense. It's not. The demand has fallen off a cliff for Model 3. Same thing in Europe. But the Model S and the Model X, now you've got the real car companies coming out with vehicles in droves. The German makers coming out. Jaguar's got them. Porsche's got them. They're all coming out. They will have subsidies. And here's the thing, Frank. Tesla needs to make a profit. These other guys don't. They sell gas engines. No matter how much the ICE, right? The combustible engine that people hate. It's bad because Elon's saving the world. Shit, man. I like EVs. You like EVs. You want clean air, right? Mm-hmm. I like nuclear power. I run a nuclear power hedge fund. Holy smokes, do I want EVs to work? Because wind and solar ain't going to do it, greenies. That ain't going to power anything. If you want it, you need a lot of base load power. So if you think about that, I love EVs, and I love that all this choice is coming out. And just think, these guys who've been making cars for decades upon decades upon decades, they want to get into the mix too. And guess what? Rather than doing product cycles in such a short time frame that Musk does, they wait, they watch the market. They're fine waiting half a decade, maybe longer. They let somebody else go out there, and now they'll come in with fresh tax credits, with kick-ass vehicles. And oh, by the way, they also have other vehicles that could help subsidize while they're growing this. He doesn't have that. So I look at it, and I listen to I love to hear the bulls, right? It's the autopilot. The autopilot, full self-driving, the message they come out with, nonsense. It's not. It's not. And they say it is. And what you see with Musk, and this is where if I'm a Tesla bull, I'm really concerned. Because when there's bad news coming, he's got something else. He's got something to promote, right? He's the ultimate promoter. He should have been a mining executive because he could promote like there's no tomorrow. You know what I'm talking about, right, buddy? So, and not all mining executives, some. But what he's really good at is focusing people where he wants their attention to ignore the really important stuff. So he's coming out the Model Y, the Tesla Semi, the Chinese factory. He's got all this stuff. This guy never delivers in a remote time frame. And here's the problem. He's got a balance sheet that's so loaded with debt. He's got massive amounts of debt. He jammed the third and fourth quarters, pulled forward all this demand, and now what does he have? He's got two really nice cars, the Model S, the Model X. The Model 3, you could say what you want. I mean, some people say it's really good. Some people say the quality is not that good. But he's trying to come out with this $35,000 version. It's going to be really difficult to make any money on it. But let's say he was. The Model S and the Model X are imploding the sales. And that was your profit engine. That was going to help get you through till you got the scale required for the Model 3. I don't think that happens. And so you'll see he's doing in next week, he's putting on a show to talk about full self-driving and the autopilot and all this stuff. More smoke and mirrors, more get people excited, try and get the stock price going. What I don't understand, and maybe he'll do it when we get off the phone, who knows, but what I don't understand is if I had the working capital commitments he has this year alone to Panasonic of over almost $4 billion in purchase commitments for their batteries, $18 billion in overall purchase commitments to them for batteries, a couple of $1 billion in working capital commitments in 2019. I mean, he's got a lot of cash flow needs this year. What I don't understand, at least for over a year plus now, is at any point in time, he could have gone out and did a capital raise when he had to pay this $925 million in this convertible note that was due recently, which they paid. Go out. You can dilute it. It appears to me the raging bulls don't really care about numbers. So if that's the case, they shouldn't have cared about dilution. So if you need several billion dollars to get some cushion, at that point, with a $50-60 billion market cap, go raise $10 billion. Dilute the company.
You know what? Like, hold up right there, because we have 2 minutes left. But I wanted to get into that too, because this is an important point, guys. And this is what I learned from you. Listen to you about this. Where you're bringing up the capital, right? So for me, if I'm short this stock, I want to try to look at every place I could be wrong. And I think I even had this conversation with you and said, well, you know what? Tesla right now has enough bulls in there, and they have a lot of big funds who are 5% plus holders, where the stock's trading at 275. You know, maybe they could do a capital raise at 225, raise 5-6 billion, whatever it is, 10% of the market cap, which would be enough for 2 years. And when I said that to you, you said something very interesting about that, because that was the thing. Well, you know, maybe they could raise capital at a much lower price, but you brought up a good point where you don't think they're going to be able to raise capital, right?
Something is amiss. This is, I don't understand. If I have 25 million Twitter followers, if bad news is good news in the stock price. Now, let's not forget, though, the stock is down. I don't have my Bloomberg up right now, but the stock is down 15-20% on the year. It's down from 380 to where 270 something. So people are starting to get the gist here, right? No matter, and that was after, by the way, he put up a really big third and fourth quarter by pulling forward all this demand to do what he could to get the stock price going, and the stock's still a lot lower than where it was. So there's something fundamentally broken, but we just haven't seen a collapse yet. But yes, Frank, so with his powers of persuasion, he could go out when he's under the gun. I don't see how it's deniable that cash flow is a challenge. And look, they lowered the numbers for first quarter. They came out, they did. So, and they've got these commitments. You could make that all go away by just going, if you're him, and going to the public markets and issuing equity, right? You could get some, I don't know what rate he'd pay on the debt, but do a capital raise. Do a capital raise. I don't know. What do you need? Do you need $5, $6, $8 billion? Normally, right, people don't like capital raise. Investors who are going to invest and participate in it might, but existing shareholders say, oh, dilution, and the stock goes down. In this case, nobody cares because valuation doesn't matter. If valuation doesn't matter, the stock would be $50 right now. So you have such fervent bulls, do a capital raise, take care of what your cash needs, and then just go about your business. Why isn't he doing it? I don't know the answer to that. Is there something? Is there scrutiny that they don't want to be exposed to? Because if you're the banker and you're doing your due diligence, you're taking on some responsibility there. I don't know the answer. I know the fact they're not doing it. And like I said, who knows? We can get off the phone today, right now, and they can do it.
Yep.
But it's been a long time, and they've come down to the wire. He was interviewed, a few months ago, and he said that in the third or fourth quarter they were down to weeks before it was kaput. Really? Call up your banker and say, listen, I want to raise this. You could do it theoretically pretty easily. Why didn't you do it? You like living on the edge that much? Or is there something we don't know about that's going on behind the scenes that's preventing that? Or that they don't want to have people looking too deep? I don't know the answer. But
Mike, that makes a lot of
It's a red flag that I can't get past. I just don't know the answer to it. And as far as, Frank, you can go so many different ways. How come there's all these cars that don't get registered right away? I mean, it's a big, meaningful number. If you go on Tesla Motor Club, you'll see stories all over the place saying, how come my car's not getting registered? I bought it. I have all the paperwork. I'm paying for. Why don't I get my plates? Who knows? They want to keep it on in inventory for their asset-backed line. I don't know, right? But these are questions that you have to ask. But what I do know, and in almost a quarter of a century of looking at companies and promotion and things that don't make sense to me, this is at the, if not the, it's close to the top of the list. It's not an indictment of Musk as an entrepreneur. He's a brilliant entrepreneur. I'm not saying he's not, right? He's found a way to get people excited about the products he's selling, and he plays it as though he's saving the earth. It's David versus Goliath, the stuttering genius, right? Oh, I'm an engineer and all this stuff, and look at us. It's us against the world, and all these bad people who drive gas cars. They're terrible. Let's go save the world. And great, he's got guys like Ross Gerber on Twitter out there all excited about the financial advisor from California. He gets people out there who have big followers, and they fervently support him. Look, everyone's entitled to their view. I get it. But at some point in time, you've been doing this a long time, how many times are you going to disappoint investors with numbers, real numbers that don't make sense? That meaning you're constantly pushing out timelines. That doesn't make sense to me. Where no matter what any CEO will tell you, they worry. What do they worry about? Meeting consensus, beating consensus, because the consequence of not is your stock gets punished. Here, it doesn't matter. It doesn't matter what consensus is for now. But it's right now. I think we're seeing death by 1,000 cuts. Like I said, the stock was at 370, 380. Now it's at 270 something, and he's been promoting the Semi, promoting the Y, full self-driving. This promo's coming. The Model 3 for 35,000. All the fanfare. It hasn't worked. So I don't know what that base is here, right? The retail guys are coming in and supporting the stock. Good news is bad news. In Elon, we trust. You know what, Frank? At the end of the day, simple math matters. And the simple math here says that margins are going to get squeezed, at least in my view. Margins get squeezed. He's got big capital commitments. And that typically, in a really tough industry, doesn't end well. And when I know the Silicon Valley types and all the millennials say, yeah, well, it's different this time, and this isn't a car company. Bullshit. It's a car company. They make cars. They compete against car companies. They have huge capital expenditures, which they're besides maintenance, they're not. You don't see a big spend. It just none of it makes sense to me. It's tricky because you look at this and say, well, how come all this bad news comes out and it doesn't implode? Some things just take longer than they think they will.
Yeah, no, I hear you. And I mean, you've been on this even for Moneyflow Trader subscribers, and it's interesting. Really quick, I remember when Baker Hughes, I think it was about to take over Weatherford, because I thought they were going to take over GE Capital, GE Oil and Gas Division, and they came out and said that, hey, we're not going to do it for some reason. And about 6 months later, Weatherford announced that they have accounting irregularities and stuff like that. So when you raise money, guys, and you have to open up your books and open up everything. And you're right. It just doesn't make sense why the company could do it at 225, because the biggest concern here is what? Cash burn and debt. And you could alleviate those concerns, at least from the bears. And the fact that they're not raising money and now you're lowering production, you're seeing top executives leave, I think you're on this thing. I think you're right. It's just a matter of time. And
Frank, somebody asked me the other day, they said, I feel bad because a lot of these investors, these retail investors, they're going to get bagged. And there's a guy on Twitter called Bag Holder Quotes. And I do too, and I don't know what the answer is, but there's this thing called FUD, which is fear, uncertainty, and doubt, and all of the bulls, the real fervent believers say that the bears spread FUD, fear, uncertainty, and doubt. There's on Twitter, and I'm not active in it because I have subscribers, so I don't want to share with the Twitter platform, but there's the community called Tesla Q. And Q is the name you put after a company files for bankruptcy. That's the symbol they get, whatever it is, Q. And there are people from all walks of life that contribute to Tesla Q. And the bulls will say it's all FUD. It's all fear, uncertainty, and doubt they're trying to make. Now, I got to tell you, I've been doing this, like I said, a quarter century. And it is, without a doubt, some of the very best work I have ever seen, bar none, on the short side. And I have been involved in some forensic accounting shorts, some deep dive shorts, that the work has been phenomenal. I've done good work. Peers of mine have done good work. This community here does work that is just absolutely stupendous. And I think one of the things, when you have 25 million followers and you are a self-proclaimed genius and the world thinks you're a genius, crowdsourcing like this, there's a lot of really smart people out there who are crazy smart, just like self-proclaimed geniuses are. Yeah. And people don't have to be financial analysts, but they can be curious and have an interest and do work. And so people should look at that. And if they think it's fear, uncertainty, and doubt, then that's shame on them, because ultimately I think they're going to have to pay for that in losses. But really solid work out there.
No, that's great stuff. So, Mike, I know you've been doing a great service to subscribers, Moneyflow Trader. We talked about, an industry itself and also this stock, which, every time I talk to you, you're telling us things that we're not hearing for months later, which is really cool. So you're definitely ahead of the curve. I know the stock is getting hit, and I think you're right. It's just a matter of time. Everything's going bad for this company. And with that, I just want to say thanks so much for coming on. I did have you as a late guest since my flight just landed, and you did me a big favor, and even the guys producing this doing me a big favor right now to get this out because it's going out a little bit later than expected. But I really appreciate you coming on as always.
Did Jacksonville forget to pay their internet bill?
I know. We had internet problems and everything, man. So I'm just glad everything worked out. So, which is cool, and we'll get the podcast out. But
that's all right. My internet goes out 3 times a day, so I get it.
I hear you. So Mike, listen, guys, you get a chance, listen to Mike's podcast, Talking Stocks Over Beer. It's really good, getting a lot of traction now. Have great guests on there, and thanks so much for coming on, Mike. I really appreciate it.
You bet, brother. My pleasure. Thanks, pal.
Okay, guys, great stuff from Alkin. Love having him on the podcast. Any questions, comments? Let me know what you thought, right? It's a podcast about you, not about me. Yeah, let me know what you thought. Frank at CurzioResearch.com. That's Frank at CurzioResearch.com. And if you are interested in his Moneyflow Trader newsletter, just go to CurzioResearch.com. A lot of happy subscribers. He's been doing well, a lot of his picks lately. And you can see the work that goes in, the education that goes in, and also his podcast gained a lot of traction, which I'm happy about. I'm always happy when people in the podcast world do well, especially in our industry. It's not competitive. It's not a zero-sum game where people can listen to podcasts, numerous podcasts. It's not like you have to listen at a certain time on a certain day, and that's it. So, the more people that do good podcasts, and I have to be honest with you, there's not a lot of great podcasts, financial podcasts out there. I try to listen to them. There's a few that I listen to that are great. But, most of them that I give a try, it's just like, it's either dry or, that they're constantly selling things or they have advertisements everywhere, which is pretty crazy. But, his is one of the good ones. So guys, definitely, if you're interested, again, it's absolutely for free. If you don't want it, you don't have to, but Talking Stocks Over Beer. And once again, any questions or comments on that interview, Frank at CurzioResearch.com. Now, let's get to some of the headlines here, right? Because we broke down Lyft last week. Lyft fell. It came out at 80. Then everyone was like, wow, this stock's amazing. And the stock fell. And I really dug into the numbers. And I didn't like what I saw. You're looking at a company where I just felt like the numbers were really padded going into the IPO. Now, what do I mean by that? It's just they raised their prices close to 25% from last year and 10% from last quarter to make their average revenue per user, basically per driver, whatever, a lot higher than it was last quarter, 6 months ago, even last year. When I looked at their market share stats, there's a company that's providing that for them that's actually an investor in the company and saying that they have a 39% market share. And there's an independent consultant that tracks these stats who's not an investor. It says his market share is more like 29%. Guys, that's a massive, massive, massive difference. Huge. I mean, if that's true, then Lyft has not really grown as fast as everyone thinks, which is important because it came out at a crazy inflated valuation. I mean, I don't even know how to value this company because they said, hey, we're not making money for like forever. I mean, they said we're not making money for, there's no projection out there. It's not like, hey, after year 3, after year 4, there's nothing out there. They don't project to make money. They raised a lot of money, billions, about $5 billion in cash, maybe a little bit more on their balance sheet from the capital raise and, the IPO. So it's not like it's going to go out of business or anything, but we had Citron come out at 70 and say, hey, you know what? I think it was like 70, 72 at, we're long this company. And I don't know, they just believe that the stock's going to go a lot higher and saying that, growth is never a reason to short a stock and the stock's going to grow a lot more and whatever, it's a lot of it based on growth. And I actually tweeted out and said, hey, because I like the guys at Citron. They're pretty good. And I don't know. Those guys are usually forensic accountants. From what I saw with this, I mean, there was a lot of red flags in here. Just a lot. I mean, you look at the dilution I talked about last week. They're disclosing 46 million restricted stock units, representing about 20% of the shares outstanding, another 13.5 million of employee stock options. I think it might be a little bit more than that. That's another 5% dilution. So you're looking at $5 billion, that's 25% dilution. That's when the stock was trading at 70. And now it's trading at 61 today. So it went down tremendously, right? And you're looking at a company, that's a bad sign. When you IPO, and you take a snap, you have all the people, right? So you have everyone that invested early. This is a liquidity event for a lot of them, right? Some of them are going to be locked up a little bit for the next, 4 to 6 months. Man, I hate when that period comes out. Those guys are going to, are praying that the stock stays over 40. I'm sure a lot of these guys were at 10, 15, 20, but, I think most of them are going to make money. I think Google invested at a valuation of more about $15 billion, and this came out at $25 billion. They might have invested at 12, 13 billion just a year ago. If you put that in perspective, even they might lose money if this thing goes down to 40, 45, around there. But when I'm looking more into these numbers, it's just, it really scares me because I don't know if the growth is real. And more important is when you look at their underwriters, they had JP Morgan Chase, cool. Credit Suisse, cool. Jefferies, cool. Who's not there? It's the biggest IPO, the most popular one of the year. What 2 names are missing from that list, which should be on that list? Goldman Sachs and Morgan Stanley. I don't care if you hate those guys. Those guys are pretty smart. There's a reason why Lyft came out and said, Morgan Stanley is creating these short products that are shorting it. And, they denied it. There's a lot of people shorting the stock right now. And it doesn't have a big float. So I look at this name. I think you're going to continue to see those short positions build. And going over the next couple of quarters, I don't think Lyft could do anything to really say, hey, look how fast we're growing or what we did. I mean, I talked to 3 different Uber drivers over the past few days, right, when I was away, and I asked them, and they were Uber. I have Uber, and I said, do you drive for Lyft? They said, yeah, I used to drive for Lyft. I don't drive for Lyft anymore. I noticed what Lyft said in their filing. They said that, we're going to have to spend more money for drivers because we have to pay them more money to give them incentive to drive during peak hours. And all 3 of these drivers told me the same thing. They said that they love Uber, and I would, unfortunately, that every time I took an Uber driver, it happened to be in rush hour both ways. And when I talked to them, they said that Uber provides much better incentives, and that's why they're using Uber. Maybe, again, very small sample size. But that was something that was in, their prospectus when they launched. Saying, hey, we're going to have to spend a lot more money to get these guys to drive during peak hours because you're not going to get as much business. It's going to take you longer to get to places, and they want to make as much money as possible. And one of the guys told me that, they'll give them like a $10 incentive on top of the fare. And by the way, when I first got there, I took a cab that cost $40. It only cost me $25 to take an Uber, right? I mean, there's a reason why there's 50 cabs there and nobody on the cab line. But I just didn't feel like walking extra quarter of a mile, half a mile or whatever to try to and wait since, I got to Baltimore late on Monday. Anyway, but when I'm looking at all this stuff and the fact that they don't have Goldman Sachs and Morgan Stanley, man, those guys are really smart. I think the stock's going to come down a lot more. And when you look at that market share, I mean, guys, that's a 10% difference in market share. I mean, who has this right? Who has these numbers right? We should have it right. There should be more people, more consultants on this. I just know two of them, and there's a 10% discrepancy. And the one that's higher is the company that's invested in them, which, they have an incentive to make sure that that's higher. I mean, that's how I'm looking at it. Maybe it's not, maybe it is. I don't know. But the person who has nothing at stake is saying that their market share is 10% less. If that's true, then this company's not growing as fast as everybody thinks they do. But they're trading at a valuation like this company's going to grow like crazy over the next 5 years. So I'd be very, very careful of Lyft here. And the dilution is going to be incredible. You're going to have the selling coming out. You got a while, 4 6 months. And most of these guys are locked up for 6 months. But as this thing comes down, they're going to die to get out, lock in their profits. I don't think these guys are going to hold this long term unless you see, the next 2 quarters being pretty positive. But companies usually have a history, unless you're Levi, which is amazing. Like their first quarter is usually like, there's a lot of things that are brand new to the company, the reporting system. And the next 2 quarters are going to be interesting. And even if they beat the numbers, man, I'm going to go through those things because they really hyped this thing up into this IPO. If you look at when they first came out, and let me see if I can really grab a date on this, guys. I'm just going to do this really quick. Hold on. I'm doing this stuff here. I don't know if I could find it. But the Wall Street Journal was reporting. I'm trying to find out when they reported this because it was so interesting. I don't know if I'm going to be able to find that date. Give me 1 second here. So I'm going to say Lyft. I love doing this stuff real time because you guys are like, wow, is he really doing it real time? Yes, I'm really typing. Okay, hold on. And this is from October, right? So we're looking at 6 months ago in October. That's when they picked their underwriters. And the valuation even says, Lyft's valuation is expected to top $15 billion. In contrast, Uber is being valued at $120 billion. Okay, that was just like in October. This thing came out at the high end. They raised it. It came out at it had a $25 billion valuation, a week and a half ago? When it was at 80, now it's at 60. That's massive. So when you're looking at all the numbers and the raising of the prices and all this, it just seemed like a lot of fluff to me. Man, I have to see the next quarter. I have to see the next couple of quarters. Maybe Lyft blow out the numbers. Maybe they are gaining more market share. I don't know. But right now, man, it's, hey, 1 red flag, 2. There's like 3, 4, 5 red flags I'm seeing here that I don't know. I think this thing could really go a lot lower from here. So be very, very careful. Wait to see the numbers. I could be wrong and this thing shoots a lot higher. You get Buffett coming in and buying. I don't know. But based on the numbers and what they're saying, it just doesn't add up to me. And 1 + 1 doesn't equal 2 right now. There's something going on with this company when I'm looking at the numbers. Again, $15 billion valuation, in October. Now it's a $25 billion valuation. These guys, the dilution is going to be incredible. And a lot of these guys are in the money on these things. So they're going to be selling them. Again, they're locked up. This thing is priced that everybody who was invested in early is going to make a lot of money. But everyone who's buying this thing in the IPO is going to get crushed. And unfortunately, there's a lot of mom and pop investors. And you know what? That's what I give a shit about. So when I look at Lyft, that's what I see. Again, I could be wrong, but just be very, very careful because what I'm saying a lot of people aren't talking about. You just say Lyft and the growth and this and that. And a couple of people say, I don't know if I like it. And they're coming out with hold ratings. But, just be careful. There's a lot of things. When I analyze companies like this, you might see 1 or 2 little things. And I'm like, I want to question. There's a lot here that I just don't get. So just be very, very careful. And another story, still in the news, is Boeing. This is a company I told you to avoid. And, because of common sense, right? Look, they're going to figure this problem out, right? It's a software problem. I talked to pilots, and it's more about when this problem happens, it's more about shutting down the system, and they have to fly a plane themselves. Unfortunately, when it comes to internationally, a lot of these guys don't have a lot of training flying the plane without any of this stuff on, of what I'm hearing. And unfortunately, that, I'm laughing because it sounds weird to me, but, it resulted in a couple of crashes. So pilots are trained here to, hey, we got to shut this thing off completely, and then, we'll be okay. We'll manually fly the plane. But what I'm hearing is a lot of these guys are used to the autopilot and the functions and the computers and stuff like that, where they don't have that much experience. And again, when that happens, it's not like an easy flight, like you're just flying. So this is me talking to 3 different pilots where, it's a software problem and they'll fix it. But more important is, what happens if another one of these things crash? God forbid. And that's why when you're seeing a company with that much, 80% of their orders, their backlog are for the MAX 737s, what are you going to do? And by the way, if you order one of those planes today, if you're an airline and say, hey, I want these planes today, they're like, great, come back in 5 years. And that's when we'll be ready. So a lot of these orders are extended over 5 years. And what's going to happen is these guys are going to be like, you know what? Let's hedge ourselves a little bit. Even if it's 5%, 10%, let's go with a different plane, right? Which the Airbus, the Neo 320, provides 15% fuel efficiency per seat. This one, the MAX, provides 20% fuel efficiency per seat. That's what I would do, especially if I'm like a Southwest where, this is their plane. They have the most exposure to this plane than any other airline. So when I'm looking at Boeing, right here, and you look at the recent news where China Eastern Airlines, they're suing Boeing over grounding the plane. American Airlines is blaming them, even though, it's 2% of their fleet. They're just, hey, improve operations. It's not the shutdown. It's not the MAX. It's because your operations are terrible. I mean, just stop canceling flights. And again, customers have a lot of choices these days. For me, I'll never fly them. I can't fly them. It's just, again, maybe it's me or whatever. But you're looking at the company just talking about first quarter where they have, the backlog is still 80% of that 737 MAX, but they said their first quarter deliveries were just 149 total commercial airplanes versus 184. And that was Q1 2018, so year over year. The company says it's going to cut production from 52 planes per month to 42 planes as they fix a software problem. That's pretty big because you're looking at Boeing was trading at a growth multiple, and you have a lot of these problems here, which is pretty scary. Now, when I look at it, and the reason why I would tell you that I think Boeing's going lower is because expectations are still sky high for this company. And that's important. Sentiment is important. When sentiment is negative on a stock and everybody has sell ratings and nobody likes it, that stock just has to report an inline quarter, and that thing could pop 20% because everyone's expecting it to crash and go terrible. I mean, the numbers have been lowered, but not to the extreme that they should be lowered here. I mean, they're like, this is, it's going to get better right away, and it might get a lot worse. It looks like it's going to get worse. But, their clients are canceling orders right now. And Boeing's going to the suppliers and explaining that to them and saying, hey, you know what? You got to slow down right now. But look at the average target price for the analyst is $434. It's still 20% higher than the current price. It's a lot considering the stock is trading at 16 times forward earnings. And you say, well, that's a market multiple. I mean, analysts are expecting this company to generate close to or even more than $18 a share. I don't see that. I see more like 16, 15, maybe 16.50. Based on these cancellations, they're still very, very high. I think it could be even less than $16. So the company's trading a lot higher than 16 times forward earnings. If you don't believe those earnings, and I definitely don't. Not to mention, even at that pace, you're trading at a pretty high multiple of 60 times forward earnings when you only grew earnings 3% from last quarter. And the cherry on top is when I look at the sell-side firms here, there's 27 sell-side firms. Sell-side firm guys are in, Goldman Sachs, Morgan Stanley, JP Morgan's, the big guys who cover the stock that provide models and target prices. That's where what you see on TV. When they're like, they beat earnings or they missed earnings, that earnings number is basically the average, median of all the analyst numbers, right? And they just say, this is the average number, here you go. And whether you beat them or not. So it's important to understand that number, because if you think, like I do, that their earning estimates are way too high, they're probably going to miss next quarter. And you know what happens in this market, especially over the past 2-3 quarters. When you miss, bye-bye. Your stock doesn't go down 2, 3, 4%. No, it gets crushed 10% plus. I can't see them meeting earn. I mean, they're just too inflated. But as 27 analysts covering it, 17 of them still have a buy rating on the stock. So sentiment is still very, very high for a company that was trading at a growth multiple that kind of still is, since you're just, basically growing earnings 3% from last quarter. And yet they're cutting growth a lot and significantly for their top product that provides 80% of their backlog. And now they're getting companies that are starting to sue them and also cut orders. And that's going to continue. And again, God forbid you see another problem. Hopefully, that doesn't happen. But there's another problem with this plane, man. Their clients are going to be like, all right, we have to hedge ourselves a lot more than just 10%, 20%. And that's what I'm worried about with Boeing. So right now, it's scary. I know the stock's down. You see a good name and say, hey, you know what? They'll figure this out. They haven't figured it out yet. And you know what? Their clients and their customers are cutting production. So you're looking at a company with a growth multiple that's cutting their growth. And you usually know what happens when that, look at NVIDIA. You can look at so many different stocks over the years. Look at Under Armour. When that growth disappears, man, those things get crushed. So you have to see the next quarter and the quarter after to see what Boeing's going to do. I wouldn't touch the stock now. I think it goes lower, at least in the short term. But I see them definitely missing estimates next quarter, unless these analysts drastically lower them into, their next quarter. But I don't see that happening. There's too much optimism on the stock right now. It's very, very scary. I think it could come down a lot more. But again, let's look at next quarter, look at the following quarter. But I'm getting a lot of questions on Lyft and getting a lot of questions on Boeing. And that's how I feel about those two names. So guys, any questions or comments, feel free to email me, frankcurzioresearch.com. That's frankcurzioresearch.com. My apologies about Texas Tech. I know it was a sleeper. I had money on it to win. I also I won money on, for them winning their bracket. But I also would have won 17-1. I think it's 17.5-1 if they won the tournament, and they should have won the game. I mean, it's sad. No idea why that coach didn't foul when he's up 3 with under 20 seconds left. I mean, a basketball nut for 30 years. I don't think I've ever seen a company. See, that's how I'm talking right now. I've never seen a team when they were up 3 and foul the opponent with less than 20, 25 seconds left, lose that game. I've never seen it. And it probably happened, but I bet you it's more than 90% that you're going to win that game. You look at what Virginia did the last 2 games and the 3-pointers they hit, and they were on fire towards the end of that game. Why would you let them shoot a 3-pointer? Foul them, put them on a line. It's 1-on-1. They miss, they lose the game. If they make both of them, you get the ball, you get your 2 foul shots, you're up 3, you do it again. You increase your odds of winning that game dramatically, and that's something that coach is going to think about for a very long time. It's Texas Tech, they blew that because of their coach. You're up 3. Less than 20 seconds left, you foul. You don't let those guys shoot a 3-pointer. They're a great 3-point shooting team. With that said, congrats to Virginia. What a fantastic story after losing in the first round. Good for them. Good for them. They won the game. They played great, unbelievable wins, the last 3 wins. And, hey, you know what? They deserve it. So, guys, thanks so much for listening. Again, I really always say this. I really appreciate your support. I'll see you guys in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.